Welcome back to another episode of Investing Explained. Here's today's question. It really makes me think of whenever I was teaching classes in macroeconomics, and for me to starting to doubt the current models we have about inflation. You are right. Like what we're typically taught is that when the economy is heating up, inflation should go up too, and that's not what we see. And the reason for that, just so everyone's on the same page, is that whenever you have economic upswing, it would lead to higher wages, it would push up price levels, and then often the Federal Reserve would then hike rates to stop the economy from overheating and to stop that inflation that will come from as a result of that. And it's kind of like it will go in cycles, and that's kind of like what we were taught and what we used to think. So you're really hitting at something good here. So what's happening now? Why haven't we seen this in this cycle and perhaps not too much in the last cycle? And the reason why is that the feedback loop I talked about before with the economic upswing, higher wages, high price levels, it's not what we have today. And the core reason for that is the productivity growth abetted by the new technology, because now you have more production that can be generated from capital and labor. And you can grow the economy faster without causing the supply bottlenecks that would typically give higher prices. And this is also hitting at what President mentioned before, that the middle class is really getting crushed. It might sound like the average GDP for the US is increasing, and it is, but it's not distributed equally. And technology is a huge reason for that. If we continue the discussion about technology, which is really key here, if you think about the prices of something like education, healthcare, food, I mean, that's all getting more expensive. And you're like, it has been so for a long time. And you're looking at the inflation rate of 1% or 2%, and you're thinking, this doesn't make any sense. And this is really a math thing. Because of technology has made certain products that takes up a huge part of a disposable income much cheaper. So, for instance, this calculation, the price of cell phones dropped 62% between 2004 and 2014. Now, you'll be like, that doesn't make any sense. Phones are expensive today. But what you do whenever you're looking at the inflation index is that you're saying, I need to have a comparable product. Now, that makes a lot of sense if you have 10 gallons of gas. If you put that into the index, that makes a lot of sense because it has the same utility, more or less. But it doesn't make any sense because that phone wouldn't have the same utility 10 years from now. So also keep in mind that the inflation number is skewed. Another thing I would like to highlight is the sharing economy, which is a new thing that we haven't seen before. If you look at something like Airbnb, they had more than 160 million guests last year. And on New Year's Eve, they had 2 million guests spending a night in the Airbnb listing. So in the old world, just that alone would be 20,000 mid-sized hotels that was built to accommodate the guests. And that would create a lot more demand for labor, cement, materials, and land. And that's not the same effect you see now because of the sharing economy. And then the last point is that we have globalization now, and to an extent that we haven't seen before. So in the old feedback loop that I talked about before with economic growth, and then you will have worker demanding high wages, as you said before. That's not the way it is today, partly because of technology, but also, even if you can replace that with technology, very often you can replace that with workers abroad. So by definition, since they will work for a cheaper wage, you can't pressure up the prices, and so the wages won't increase, and in turn, the inflation. So I guess that was kind of like my own reflection of how macro has changed, how inflation has changed, and how we probably need to rethink inflation and what to do about it in this new globalized and technological world. But I really like your question, Tan, and thank you for allowing us the chance to talk about this in depth.
So this is a very appropriate question for this episode, Tan, and I'm going to hand you off to an article in our show notes. Ray literally just wrote this article last week. He published it on LinkedIn, and it addresses this exact issue that you're highlighting. And a lot of it comes down to the effects of quantitative easing and what it actually ends up doing to the economy. So everything that you described, 100% accurate. And what you're seeing is this obliteration of the middle class. And so where you are seeing growth, you're seeing growth in the hands of the elite. You're seeing the asset accumulation and the asset appreciation in the hands of the elite. He goes in and he quantifies everything with stats and statistical proof to back up every one of the claims that he has to substantiate his position. All right, for the second part of the question where you're asking about where do you think things are going to go? For me, I took a lot of my cueing from people like Ray, from Warren Buffett, some of these other guys. And what these guys are all talking about is the central banks starting to take a different approach moving forward here at the end of 2017 and into 2018, where they feel that a lot of the central bankers are going to start to turn off a lot of the quantitative easing that's been so prevalent in the previous decade. You're already seeing that with the Fed here in the US. You're still seeing the ECB and the Bank of Japan doing quantitative easing at humongous rates. So for me, I'm having a hard time buying it. You know, I recently heard an interview with Ray on Bloomberg where Ray was saying that, 2018 is going to be the year where the central banks start to reverse. What you're going to see is that bonds are going to start to sell off and you're going to start to see rates on bonds going up. That's what his expectation is moving into 2018. Ray also said that it's not that he's a bull on stocks, but I think he's cautiously holding. And I think he still has a fairly sizable position in stocks, but I think that he's not looking to call a huge upside there. I think that it's more of a sustainment kind of thing. So my expectation is very similar to all of that. I think that the bond market is going to have a fairly substantial sell-off. I think most of the sell-off in the bond market is going to happen on the short end of the yield curve, on the duration side. So like the shorter duration bonds are the things that are going to be moving a lot. If you get out near to the 30-year side of the bond yield curve, I think it's going to probably be pretty flat, maybe go up a little bit, which means that it would sell off a little bit. But, I would agree with that expectation. One concern that I'm going to say is that I think the ECB and I think the Bank of Japan are much more of a wild card to pull in their quantitative easing efforts than I think people are giving them credit for. I guess my opinion is I think they're going to continue to print. I think they're going to continue to, swap cash for these bonds on their market. And I think they're going to continue to do that until we start to see some things fundamentally start to break. I don't have any other reason to believe otherwise, because even when the Fed was saying that they were going to pull things back and that they're going to raise rates and they're going to do, for every time they said they were going to raise rates, they would do it one for every 3 times they would say it, or once every 4 times they'd say it. So their believability, and Ray talks about that in the book, what's the believability that you're indexing them at? And for me, the believability part of it is extremely low. So although I think the market is extremely high with a Shiller PE at 31, I don't necessarily see things, I don't see credit contracting at a rapid pace because I don't see central bankers really changing much of their policies anytime soon.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.